Welcome to StokTok's deep dive into Wells Fargo and Company. Wells Fargo is one of the largest financial services institutions in the United States, providing banking, investment, and mortgage services to millions of customers across retail, commercial, and wealth management segments. At the time of recording, Wells Fargo trades at $79.42 per share. Over the past 52 weeks, the stock has ranged from a low of $68.67 to a high of $97.76, positioning the current price toward the lower end of that range. The 50-day moving average sits at $81.48, while the 200-day moving average is at $83.91, suggesting the stock is trading slightly below its intermediate-term trend. The Relative Strength Index, or RSI, a momentum indicator that ranges from 0 to 100, stands at 43.3, which is neutral territory. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Wells Fargo generates revenue primarily from net interest income. That is, the spread between what the bank pays depositors and what it charges borrowers, as well as fees from investment advisory, wealth management, and transaction processing. The company's competitive position rests on its large branch network, substantial deposit base, which creates a stable, low-cost source of funding, and established relationships across consumer, commercial, and institutional client segments. However, the company has faced significant regulatory and reputational challenges in recent years, which have affected its standing with regulators and investors. Now, let's look at how StokTok scores this investment opportunity. Wells Fargo scores 31 out of 100 on the StokTok framework. That is an avoid rating. Breaking this down, Valuation scores 4 out of 20, Financial Health scores 7 out of 20, Profitability scores 6 out of 20, Growth scores 6 out of 20, and Smart Money Positioning scores 8 out of 20. This is a cautionary profile across nearly every dimension. Now, valuation. The question every investor has to answer: are you paying the right price? Wells Fargo trades at a price-to-earnings ratio, or P/E, of 12.56 times trailing 12-month earnings. That is substantially below the broader financial services sector median, which has historically traded around 14 to 16 times earnings. The forward P/E, based on consensus estimates for the next 12 months, is 11.64 times, which further suggests the market is pricing in either moderate earnings headwinds or structural discount to peers. However, the PEG ratio, which divides the P/E by expected earnings growth to show whether a stock is cheap relative to its growth rate, is 2.19. A PEG above 1.5 to 2.0 typically suggests the stock may not be offering compelling value given growth prospects. The enterprise value to EBITDA multiple, or EV/EBITDA, which compares total enterprise value to earnings before interest, taxes, depreciation, and amortization, is not available in our dataset, making a full capital structure comparison difficult. However, the price-to-sales ratio, or PS, sits at 3.06 times. In our view, the data suggests Wells Fargo carries a structural valuation discount to peers, likely reflecting both regulatory overhang and modest earnings growth trajectory. GuruFocus Value, at the time of recording, calculated the intrinsic value at $69.57, while the stock traded at $81.41. This implies a negative margin of safety of 17.02%. In other words, the stock trades at a premium to that model's estimate of fair value. Wall Street analysts, at the time of recording, maintain a consensus mean price target of $97, with targets ranging from a low of $85 to a high of $113 across 23 different analysts. That represents roughly 22% upside from the current price, suggesting the street still sees room for multiple expansion or earnings recovery. The next earnings report is due July 14, 2026, with the street expecting earnings per share of approximately $1.71, with estimates ranging from $1.63 to $1.83. That catalyst will be important to monitor. Market sentiment around Wells Fargo, as of the creation of this video, leans bullish, with broader banking sector sentiment supported by record capital returns to shareholders and constructive analyst commentary. However, this sentiment is tempered by mixed outlooks and cautious investor positioning given the company's specific regulatory and reputational headwinds. In our view, valuation is not the core problem. Wells Fargo is not expensive on an absolute basis, but the margin of safety, relative to current price, is thin. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist developed by finance professor Joseph Piotroski to assess the overall financial health of a company, comes in at 6 out of 9 for Wells Fargo. A score of 6 suggests moderate financial health with some concerning signals. The Altman Z score, named after financial researcher Edward Altman, is a 5-variable model that estimates bankruptcy risk. Wells Fargo's Z-score is reported as 0.00, which is the lowest possible reading and indicates severe financial distress in the model's framework. This is not uncommon for financial institutions, as the model was designed for manufacturing firms and does not account for the unique balance sheet structure of banks, where high leverage is normal and acceptable. For a bank, what matters is capital adequacy relative to regulators' minimum requirements, not absolute leverage. Wells Fargo's cash-to-debt ratio, measuring liquid assets relative to total debt obligations, is 0.81. This indicates the company has roughly 81 cents in cash and equivalents for every dollar of debt. In a normal economic environment, this is manageable for a bank, though it does reveal limited excess liquidity. The interest coverage ratio, which measures how many times a company can cover its interest expense from operating earnings, is not available in our data. The current ratio, which compares current assets to current liabilities as a measure of short-term liquidity, is reported as 0.00, which is again not meaningful for a bank because of how deposits and loan assets are classified on the balance sheet. The debt-to-equity ratio, measuring total debt relative to shareholder equity, is 1.21. This means Wells Fargo has $1.21 in debt for every dollar of equity, indicating moderate leverage. For a large bank with stable deposits and regulated capital requirements, this is structurally normal, though it does mean the company operates with significant financial leverage and relies on continuing access to capital markets. In our view, the headline financial strength scores are weak, but context matters for financial institutions. The real concern is not the Z-score, which is a poor fit for banks, but rather the regulatory capital constraints that Wells Fargo operates under following prior compliance failures. The company must satisfy multiple capital ratios mandated by the Federal Reserve, and any shortfall could restrict dividends or share buybacks. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, which measures how much profit the company generates on every dollar of capital deployed, is not available in our dataset. The gross margin and operating margin metrics are reported as 0, which reflects the fact that financial institutions do not have traditional gross or operating margins. Their revenue structure is fundamentally different from product-based businesses. What matters for a bank is net profitability and how efficiently it deploys its balance sheet. The net margin, which measures net income as a percentage of total revenue, stands at 25.6%. This is a healthy figure and indicates that Wells Fargo converts roughly 26 cents of every revenue dollar into bottom-line profit. This is actually competitive for large universal banks. However, the free cash flow margin, or free cash flow margin, which measures operating cash generation after capital expenditures, is negative 22.42%. This is a red flag and indicates the company is not generating positive free cash flow relative to revenue. For a bank, this can reflect the seasonality of deposit flows, loan originations, and investment portfolio changes, but it also suggests limited excess cash available for shareholder returns after maintaining the balance sheet. The return on assets, or ROA, is 1.05%. This measures net income as a percentage of total assets and is a standard efficiency metric for banks. 1.05% is modest and below the historical average for top-tier financial institutions, which have historically generated ROA of 1.2 to 1.5%. The return on equity, or ROE, is 12.02%. This measures net income relative to shareholder equity and is the return equity holders are actually earning on their capital. 12% is reasonable but not exceptional. Large banks with strong competitive positions have historically achieved ROE in the 14 to 16% range. In our view, Wells Fargo's profitability is reasonable on a net margin basis, but efficiency metrics like ROA and ROE are trailing peer performance, and the negative free cash flow margin is a structural concern that warrants closer examination. Onto growth. Is this business expanding, and at what rate? Wells Fargo's revenue growth over the past 3 years comes in at 4% annualized. This is modest and suggests the company has largely flatlined on a revenue basis. The 5-year growth rate is higher at 7.6% annualized, but this comparison includes the recovery period following the regulatory and compliance challenges from the prior cycle. When we look at the trailing 3-year figure, which better reflects current competitive conditions, the picture is one of a mature institution struggling to expand its top line. Book value per share growth over 3 years is 8.2%, which is slightly ahead of revenue growth and indicates the company is growing shareholder equity, albeit incrementally. The dividend yield, which measures the annual dividend payout as a percentage of the current stock price, is 2.15%. This is a meaningful yield that exceeds current money market rates, making it attractive to income-focused investors, but it also means that total return expectations are heavily dependent on capital appreciation rather than organic dividend growth. In our view, the growth picture is the core structural constraint on this investment. A 4% 3-year revenue growth rate in an economy that has grown nominally at roughly 3 to 4% suggests Wells Fargo is not capturing market share or expanding its addressable market. Regulatory restrictions on dividend and share buyback capacity, a consequence of prior capital constraint failures, further limit total return potential. For an investor to generate acceptable returns in Wells Fargo, capital appreciation must drive performance, and that hinges on either multiple expansion or a material recovery in profitability. The current setup does not strongly suggest either is imminent. Now let's talk smart money. What institutional capital is actually doing with this name? Wells Fargo is held by 27 top-tier gurus and super investors tracked by Dataroma, a database of professional investor holdings. However, the recent positioning is mixed. Tweedy Brown, which held 4.21% of its portfolio in Wells Fargo, has reduced that position by 3.82%. Christopher Davis of Davis Advisors, whose firm maintains a 3.46% allocation to Wells Fargo, has conversely added to the position with a 6.06% purchase. Francis Chu of Chu Associates, with a 2.75% portfolio weight, has taken no action. Harry Byrne of Sound Shore, maintaining a 2.73% position, has trimmed slightly with a 0.61% reduction. And Richard P. Zena of P. Zena Investment Management has significantly reduced his 2.27% holding by 12.1%. This pattern of mixed activity, some gurus buying, others selling, is a yellow flag. Absent a clear consensus around accumulation, we should be cautious about reading smart money as a bullish signal. Among the broader 13F filing universe, which tracks institutional holdings above $100 million in assets under management, 15.8% of filers are net buyers of Wells Fargo, meaning they own a larger position than they did in the prior filing. An institutional consensus is generally considered bullish once you exceed 50% net buying activity. Wells Fargo is well below that threshold at 15.8%, indicating that large institutions are broadly neutral to cautious on the name. Insider ownership, the percentage of shares held by company executives and directors, is 0.27%. This is extremely low and represents a red flag. When insiders own very little of their own company, they have limited personal financial incentive to maximize long-term shareholder value. In the prior 3 months, there have been 0 insider buys and 3 insider sells. That pattern of selling with minimal ownership creates a perception problem. It suggests insiders lack conviction in near-term appreciation. In our view, the smart money picture is decidedly cautious. The major gurus are split, institutional buyers are in the minority, and insider activity is passive at best. And finally, the verdict. Let's bring it all together. Valuation. Wells Fargo is not trading at a discount to intrinsic value, but rather at a slight premium based on GuruFocus methodology. However, it trades below both its peer group and historical multiples, offering some appeal to value-oriented investors, though that discount likely reflects justified caution about growth and competitive position. Financial strength. The balance sheet is adequate for a large bank, with moderate leverage and reasonable capital coverage. However, regulatory constraints significantly limit financial flexibility on capital deployment. Profitability. The company is profitable, with net margins that are healthy in absolute terms, but return on assets and return on equity are trailing peer performance, and negative free cash flow margins suggest operational cash generation is constrained. Growth, this is the critical weakness. Revenue growth of 4% over 3 years is modest and suggests Wells Fargo is not expanding meaningfully in its core markets. Coupled with restricted capital deployment, total return potential is modest. Smart money. Major institutional investors are split. The broader 13F universe shows minimal net buying, and insider ownership is negligible with recent selling activity. This pattern suggests a lack of conviction among informed investors. In our view, Wells Fargo presents as a mature financial institution trapped in a modest growth profile, operating under regulatory constraints that limit capital return optionality and facing a cautious market. While the dividend yield offers some income appeal, and analyst price targets suggest near-term upside, the structural growth and profitability challenges, combined with the absence of clear smart money enthusiasm, argue for caution. This does not appear to us to be a compelling entry point at current valuations. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Wells Fargo and Company. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.